Welcome to the sixth episode of Dividend Investing Insights, your go to source for all things dividend investing. Join us as we explore techniques to maximize your investment returns. Subscribe now and take control of your financial future with the power of dividends. Before we start the episode for this week, a quick recap for the week's markets. The share markets were mostly flat with S&P 500 gaining a marginal 0.15%. Nasdaq felt a small 0.86%, while locally here ASX 200 gained 0.85% to end at 8,091.9 points. Anyway, as I have said earlier, as a dividend investor, you should not be excited or alarmed by these movements as share prices go up and down all the time. And you, as an investor, should focus on companies that have the ability to pay consistent dividends in the current year and increase dividends in the years to come. In the last two episodes, we had looked at financial ratios for price to earnings, price to sales, price to book, and price to cash flow. In this week episode, we will compare the PE ratio and PB ratio for stocks of the same industry and in the same geographical region. Before we start, a quick reminder: price to earning ratio measures the current stock's share price to earnings per share, while the price to book ratio measures the market price per share divided by the book value per share. So, today we will look at two groups of shares. The first group is the four large banks in Australia: Commonwealth Bank of Australia, ticker symbol CBA; ANZ Bank, Westpac Bank, ticker symbol WPC; and National Australia Bank. The second group that we will look at is the large US technology companies, which is Apple, Microsoft, Alphabet, which is the parent company of Google, and Meta Platforms, which is the parent company of Facebook. I can tell you right up front that you will be amazed with the results, and you will realize that while buying a share, it is important to compare against companies of the same industry and the same geographical region. So let's start. First, we look at the four large Australian banks. The first bank we have is Commonwealth Bank of Australia. CBA is the largest bank in Australia. It has the largest market cap in Australia. And among the banks, and at the time of the recording, has a share price of 139.5 Australian dollars. So basis the market price, the PE ratio comes to 24.82 and the PB ratio is 3.24. Looking at these numbers in isolation, it would appear that the stock is significantly overpriced. However, let us look further and let us look at the next bank. The next bank we have is ANZ Bank, and at the time of recording has a market price of $30.4. And using this price, we determine the PE ratio and the PB ratio. The PE ratio is 13.38 and PB ratio of 1.3, which is comparatively better than CBA. Anyway, let's look further. The next bank we have is Westpac Bank, and as of the recording, market price is 31.24, which gives a PE ratio of 17.45 and PB ratio of 1.49. The numbers are similar to what we saw for ANZ Bank. The last bank we have is the National Australia Bank, and the National Australia Bank, as of this recording, has a market price of 38.17, resulting in a PE ratio of 17.35 and the PB ratio of 1.92. Now let us put all this data together and see how they stack up. Clearly, if you are wanting to invest your hard-earned money, CBA seems to be significantly overpriced. ANZ, WBC, and NAB are similar. But if you, as an investor, if you're wanting to invest, do not look at this data alone. You need to look at a number of other parameters like dividend yield, payout ratio, the financial health of the bank, and a number of other figures. However, looking at this data, you can clearly infer that if wanting to invest in a bank in Australia, look for a PB ratio of less than 2 and a P/E ratio which is less than 20. Now, looking at this data in isolation, clearly it appears that ANZ Bank will be a better buy as compared to others. So, so let's look at the next set, which is the large US technology companies. A quick reminder, we will be comparing Apple, Microsoft, Alphabet, and Meta platforms. So let's go. First, we have Apple, and as of this recording, Apple has a market price of $229. It has a PE ratio of 34.86 and a PB ratio an astounding 52.19, quite large. Anyway, let's look further. The next we have is Microsoft. Microsoft, as of this recording, has a market price of $417.14, resulting in a P ratio of 34.97 and a more friendlier PB ratio of 11.44. Let's look further. We next go to Alphabet, parent company of Google. As of this recording, it has a market price of 165.11, a P ratio of 23.69, and PB ratio much closer to what we expect a PB ratio to be of 6.76. However, what you will notice is a trend that is emerging. The US technology companies are overpriced. Um, and if you are wanting to invest, be prepared to buy at a P ratio of greater than 20 and a PB ratio of greater than 5. Anyway, let's look at the last company, which is Meta Platforms, parent company of Facebook. As of this recording, has a market price of 521.31, resulting in a P ratio of 26.64 and a PB ratio of 8.42. Again, it's very similar, while slightly higher than Google, but in the same range. Now let us put them together and see as to what we see. Again, Apple, Microsoft, Google, and Meta. So while personally I would not want to invest in these companies given that they are so significantly overpriced, but you, if as an investor, if you see benefit in investing in these companies, be prepared to buy at a P ratio of greater than 20 and a PB ratio which is between 5 and 10. Typically, as a value investor, I would want to invest in companies that have a PB ratio which is less than 3 and a good dividend yield, a reasonable payout ratio, good financial health, and a P ratio that is between 10 and 15. Anyway, looking at this data alone, you as an investor, if you want to buy a stock among these four companies, Google seems to be the most, a buy, which is lower overpriced as compared to the rest of the overpriced stocks. Again, quite a high PE ratio and PB ratio, but Alphabet is better than others. So that brings us to the end of the episode today. And thanks to all of those who have been watching until now. Putting the checklist again, I encourage you to use this checklist, assess shares, and most importantly, subscribe to the channel, like the episode, provide comments so that we can provide more insightful videos to you. So until next time, thanks a lot for watching. Until the end, see you soon for another interesting episode of Dividend Investing.